We are live.
Oh, are we?
We
No,
are
we're not.
live.
No, we're not.
Yeah, we are.
Oh, we are live.
Are we?
Yes.
Yeah.
We're rolling.
Well, good afternoon. It's a little overcast outside this December the 16th. Welcome to the Jack and Bill Show. Pardon?
Turn your phone off.
My phone is going off. Thank you, Wesley. Well, Bill, it's been an interesting, challenging week.
Yeah.
And
markets have been overcast.
I want to tell our viewers, if I can make it, I woke up at 3 a.m. with my throat not doing very well. But I'd like to say, Bill, I looked at a December calendar and tallied up. We have 9 trading days left this year. So that's 5 days next week. Christmas is celebrated or observed Monday the 26th. And so we have 27, 28, 29, and 30. So there's 9 days. So what do we need to do for these last 9 days?
Tell them what we've been doing.
Yeah, what we've been doing is we've done over 100 required minimum distribution IRA distributions. And I just say with that, if you're over the age of 70 and a half or 72, depending upon the date of the death of the decedent, prior to January 1, 2020, it's 70 and a half. Mm-hmm. You have to start taking money out of your IRA. There are very stiff penalties, 50% by the IRS, if you miss them. So post 2020 deaths, the beneficiary who inherits these IRAs has 10 years to empty them out, and they don't necessarily have to take one this year. But we've just we've completed. I think we have one left, and they actually, under the old rules, have until April to take it out. So
the rules are complicated,
very,
and it depends on the situation. So it's always good to ask a professional if you're not sure.
Absolutely. Because you don't want to get that wrong, Bill. So we've been doing that. And then if I could pat ourselves on the back, this was a year that, man, has it gone by quickly. Yeah. In January, we felt that growth stocks, and including the S&P 500, which you really can't call growth, but growthier and higher PE multiples than the stuff that we really like.
I'll interject and say the S&P 500 has had a growth bias because its market cap weighting and the biggest companies in the index, think about the big mega cap tech companies, have had an outsized influence on the performance of that index.
No, that's a terrific point. Thank you for interjecting. So we took a lot of that kind of money off the table in January and rotated into things that we thought were more palatable. And it just so happens that actually worked out for us very favorably this year. And so, but we get into a horrific year this year. You could call it the worst bond market in U.S. history. At least for long dated bonds for sure, and short dated bonds, haven't fared that well either. Long dated bonds are down 20% or more in most cases. So we've had to go back here at year end and try to find things that are down. So you have a like security, tax loss sell or swap it into something that's pretty much the same. It's easy to do with ETFs and things like that.
Well, so it's really a bitter pill to swallow if your portfolio is down on the year, as most portfolios are, and then on top of that, you get hit with capital gains taxes on realized capital gains. But that can happen, and it does happen.
Yeah, and you have to watch. A lot of people in this day and age own mutual funds, open-end mutual funds, 40 Act funds, and they're required by law to distribute their realized capital gains annually as they realize them. So we're getting a lot of capital gains dumped on us at year end, but we're getting some of those. We're getting those in some areas that really helped us in managed futures, for example. We own a handful of managed futures funds that are up anywhere from 15 to 25% this year. So, that's really helped.
Mm-hmm.
So, and I want to tell our viewers, I think you're really going to want to tune in next week, because we're going to talk about how we should be positioned for the coming year, and what we think or what we feel, being entrenched in the markets every day might be the place to be next year, where the risk to reward trade-offs are worthy of putting your money.
Yep.
So, but it's been an interesting week, Bill. We had the market had made a fairly nice rally. All of the major indices, well, two of the major indices are above the 65-day moving average. They had actually gone up through the 200-day moving average, except for the NASDAQ composite. And this week was a difficult week. So Tuesday we came out with the CPI print after an ugly PPI number, wholesale good prices, producer price index number from the prior week. The CPI came in 0.2% better than expectations at 7.1. So the market had a nice little rally Monday and Tuesday. Wednesday, Jerome Powell and the Federal Reserve conclude their 2-day FOMC meeting with a 0.5% hike. That was expected, but they came out with their dot plot. Nothing seemed, they really had to ratchet up all those numbers. Sure. And nothing seemed surprising to me, but Wall Street acts like they're surprised by it. And Powell, continues to speak hawkishly. But here's a takeaway that I would get from that, Bill. So now the Fed funds is at 4.25 to 4.75. And the dot plot is suggesting a peak, near 5%, 5.1. That's just two more rate hikes of what we had this week, and the Fed is done. So they meet again in February, and they meet after that in March. And I think that we could see now.
The consensus has to be right.
That's correct. So as they say over and over and over, it's data dependent. What is the data? It's mostly the inflationary numbers and then what's happening with the economy. And if they see that they've gone too far and things start to turn dramatically, I think they'll just go right back to what they've done every other time in the past and go back into easing and so forth. But at the same time, I do think Jerome Powell's committed with inflation. So year to date through yesterday, the S&P 500 was down 17.0%. Today it declined 1.1%. So call it the broad blue chip stock market is now down 18% year to date. Mm-hmm. It's about the same as the long dated bond market. The NASDAQ composite was down 1% today. It's down a lot more than that year to date. And the Dow was down 85 basis points today. And it's down. I haven't looked recently. It's down something like, 10 or 11% this year, Bill. That's a huge divergence from improvement over the S&P 500.
Well, I think one of the biggest takeaways of the data that you just cited is that for this year, there's been no place to hide for investors in traditional balanced portfolios of stocks and bonds. You needed to have something else in the mix. what we call alternatives to have done relatively well.
Yeah. So, I mean, before we really get into the meat of what you wanted to share with us, William, I'd say, yeah, the Dow Jones Commodity Index, I mean, it's up 10% this year. It was up over 20%. So we've seen near term, we've seen some of these commodity prices come back. You realize crude oil's it's up 1% in the last 12 months. So we've had, crude come back down to 74.5. Actually, that puts it flat on the year. The big story has been natural gas, which closed yesterday at $6.97, up 87% on the year. That's really benefiting the local economy here. And we've seen a resurgence in gold and silver in the last few weeks. So that to me, could be telling. But I'll tell you one other thing that I noticed, Bill, in all this is I like to look at how one of the most widely held bond funds, the Dodge and Cox Income Fund, probably 2 or 3 months ago was down 15% on the year. It's rallied to being down about 9% year to date. But what's really kind of alarming about that is they are a value shop. So their bond fund is down more than all of their stock funds.
Yep. So
their safe money fund is down 9%. Their global stock fund is only down 6.5%. Their domestic stock fund is down 7.5%, and that's markedly better than the S&P 500. And that's because if you look at the Vanguard Growth Admiral versus the Vanguard Value Admiral funds, the difference is like down 30% versus down 2 or 3% this year. Mm-hmm. So there's been a huge difference. It's been a stock pickers kind of market this year. You've needed to own dull and boring, not tech and growthy type stuff. Things like Amazon, for example, have taken a big hit. So let's see. That's about it, William. Where are we going today?
Well, it's December. It's year end. So you know what that means? Year end forecasts. So this is the time of year when Wall Street parades out their strategists and economists to get some airtime. And everyone loves reading forecasts. Well, here's the problem. Most forecasts are wrong. I find it interesting. Their Money Magazine does an annual tax return test of accountants, and they use a sample size of 50 accountants for this test. So this is preparing a tax return, right? A pretty simple, straightforward tax return for a family of 4. Now, this is looking at backward-looking data, right? We're not looking forward, looking at the past. So you're assuming same tax code, the same income tax reporting software. You're looking at the same facts. What's different across these 50 sampled accountants? Well, different individual judgments on the tax owed, and we call that noise. So you have a wide divergence of views from a pool of 50 different accountants looking at the same information. I find that very interesting. Here's another study, and this is a classic study of medical pathologists. So they're shown the same biopsy slides at 2 different times. The average correlation between the judgments of these pathologists of what kind of disease they're looking at was only 0.63. So 1 is perfect correlation. That means everyone is in agreement. So you have medical pathologists looking at the same information, and they come up with different results. So that's looking at what we have. That's looking at the same data or looking at the past. How much harder is it then to make judgments about the future. It's a lot harder, but yet that's what Wall Street likes to do. And so, as I said, they want to parade out their strategists and their economists. You have these talking head experts with little to no accountability because they're not managing people's money.
What happens if they're incredibly bearish?
Well, they're not going to have a job for long. And we know someone who had a very bearish view. He worked for Merrill Lynch. He was their head economist, and he had a bearish view. And the joke he likes to tell is that you couldn't work for Merrill Lynch, who has a bull for their logo, if you're bearish. But here's what we know. Expertise, and this is based on studies, expertise does not improve forecasting skill. That's been proven. And sometimes the best thing that someone can say is, I don't know. Well, guess what happens to a Wall Street strategist or economist who says those three words? They're not going to get airtime on CNBC. And they're probably not going to have a job for long because they're paid to make forecasts. So why even bother? What's the point of even doing all of this? Well, Wall Street is giving investors what they want, and investors crave certainty. We all do. And we have this tendency to follow the herd. I guess it makes us feel better about our decision making when we can say, well, everyone's in the same boat. And we hear that a lot from investors, when they're talking about their performance, especially this year. They'll say, well, but everyone's down, so it's not so bad. Well, I mean, that's a factual statement. Most investors are down this year, but there's degrees. And maybe that does, make you feel better about yourself. But if you want to be average, you do what everyone else is doing.
True.
And I look right now.
This has been one of our, interject.
Yeah.
This has probably been our best on a relative basis year ever.
Yeah. Oh,
I mean, we have some clients that have actually made money this year, and depending upon their allocation.
I think one of the biggest consensus calls right now is recession in 2023. And that takes no courage to say. Everyone is looking at the same data, right? It's just like the test that I cited, the study of the clinical pathologists or the accountants doing the tax returns. Everyone's looking at the same data, basically. But we have a wide divergence of views. But I think in this case, with the recession call for next year, it's a tight grouping. It's a pretty wide consensus view. And sure, we could say, yes, there's going to be a recession next year, and we could cite all kinds of reasons why. But I wonder, the contrarian in me wants to think, what if everyone's wrong next year? That would catch a lot of people by surprise. Well, there's a whole field of study called behavioral finance, and it applies psychological influences. It's studying those psychological influences on investor behavior. And it's really very interesting. And the bottom line is this: humans are just not wired to be good investors. And we can be our own worst enemy. And I saw this article today, Jack, and it's really kind of heartbreaking. This is an article that Reuters came out with. It's dated December the 16th. And it cites two JP Morgan analysts. It says, on average, retail investors' portfolios are down about 39% in 2022. 39% down. Well, as you said earlier, the S&P 500 is down 18%. How can these retail investors, on average, be down 39%? Well, one reason is because we saw retail investors speculating into things like meme stocks and SPACs and cryptos and other things like that, and they got burned on those things this year. But I would say that it's also just classic cognitive cognitive shortcomings when it comes to investing because of these behavioral issues.
Oh, if you look at, and I'll tell you this, Bill, here's an example to just throw a monkey wrench into some of what you're saying,
Yeah.
or an example where we can go the other way. You know, there's some bond funds out there that are experiencing net withdrawals in a big way. Well, I can tell you, you know, if I structured a one year bullet portfolio with U.S. Treasury securities, I can tell you with 100% certainty what that portfolio is going to do in the next year. And here's a big positive takeaway: is it's going to make somewhere close to 5%, and that's dramatically higher than had you purchased that same portfolio a year ago.
Very true.
You know, so there's huge opportunity there, and there's a much higher degree of certainty. Yeah.
Yep. So, what are some of these cognitive issues, you know, that we all have to wrestle with? We all do, and we've made mistakes ourselves. Professionals are not immune from making these mistakes. Well, it's a lot of them are under the category of bias. For example, using rules of thumb or what are called heuristics. It's helpful to come up with rules of thumb, especially when you're analyzing lots of information. But applying a rule of thumb can also get you into trouble. And we see this like with, like for example, with seasonality in the markets. You know, sell in May and go away, or you know, put your money to work in the fourth quarter because of the Santa Claus rally. Those are a couple of examples. And, you know, that may work more often than not, but it's not foolproof. Here's a big one. A big example of a bias is overconfidence in your own abilities, but also in how you assess your abilities relative to the abilities of people around you. That's one that gets us into trouble. Another one is confirmation bias. And that's where you dismiss or discount information that's inconsistent with your views. So you have a view that you believe, and then as new information comes in, you don't want to pay attention to it because you've already established what your thesis is or your view. And I am glad that the Fed has said that they are being data dependent. So that implies that as new information is coming in, they are taking that into account.
I'll throw a wrinkle in with that too, Bill.
Yep.
You've heard me say this many times before, but the way the human mind works, we give the greatest weighting in our minds to that which we hear and see and experience most recently.
Yep.
And then we extrapolate that into the future. So what that means is, so let's say that you own a portfolio of NASDAQ stocks and they're down 30% this year. That's pretty close. Then you get really fearful because you make this comment that, or this, you hold this view or belief that the NASDAQ market is in decline. It's going down. It's going lower.
Yep.
And then so this is why I would say when you said retail investors, I would put a slight tilt or shift to that and say the overwhelming majority of do-it-yourselfers. We've been in the business. I've been in the business since 1990, and I have found very few people that know what to do during times of trouble in the do-it-yourself community.
Yeah.
And that's why this is the year that advisors really needed to, where investors needed to have an advisor.
Yeah.
Because I believe, you know, we make a difference. So think about that. So what you have, and the reason why those individual or retail investors, as you say, have done far worse than the market is because they apply that concept of giving the greatest weighting in their minds to that which they see and hear, read, most recently, extrapolate it farther. And what that means is that you sell low and you buy high.
That's correct.
And we actually try to do the opposite of that. But if you make a rule out of that, that's not going to work every time either. Doing the opposite of that, because, for example, the NASDAQ market could easily go down another 10 from here, or 15%, depending upon what's coming, in the first quarter.
Well,
So
or just momentum in general.
Absolutely.
Markets tend to go higher than they should, and then they have to what's called revert to the mean, get back
Yeah.
to the trend line.
Because of two very powerful emotions: fear
Fear and greed.
and greed. And the most gut-wrenching thing to do is purchase something when there's blood in the streets.
That's exactly right. I'm glad you mentioned that.
But that's where you make the most money.
That's correct.
I mean, now that that's if you're right. Okay.
Yeah.
But if you have a process of vetting things out and doing that, you're going to be if you can just be right 60 or 65% of the time, you're going to crush. You're going to beat the market, actually.
Well, and I like that word process. It's recency bias is the term for it, and I think especially as we're going into the new year, investors need to be very mindful of recency bias. Okay, we've had a really tough year in both stocks and bonds, so a lot of people have just moved to the sidelines, and they're just in cash.
Yeah,
because they think, well, this. It's broken. The market's broken. No, the market's not broken. The market's doing what it does. And over the long run, it's going to exceed the returns we would expect to make in cash or in the bank.
And cash is not a good idea with
Not for the long
short-term
run.
yields, 4 or 5%.
Exactly. So what makes a good forecaster? Or I could rephrase that. What would make us better investors? Because we have to make assumptions about the future when we invest. We take into account past information, what's happening now, but we have to make reasonable expectations or assumptions about the future. Well, this is, and I want to tip my hat to Morgan Stanley. They cited a really interesting Harvard Business Review article about all this, and there's different areas here that they've identified that make good forecasters. And the first is a philosophical approach. And they have found that people who are cautious and humble and non-deterministic, meaning they don't assume that what happened was meant to be, tend to do better at forecasting. Humble, cautious, right? Another trait that they found was that good forecasters have a very strong ability to think. They're open-minded, they're inquiring, they're reflective, and they're numerative, meaning they can work well with numbers. A third trait that they identified was methodology, or process, as you said, Jack. So, like the methodology would include like being pragmatic, meaning being open to new ideas, not being married to an agenda or a thesis, being analytical and considering other points of view, synthesizing, meaning being able to take others' views and synthesize them with your own, being probabilistic focused, meaning, applying mathematics and probability statistics, thoughtfully updating as new facts warrant it, and that's something we've talked about, and being self-aware of their own cognitive and emotional biases. We all have them.
Or weaknesses.
Right. Well, they are weaknesses. If we're not aware of them and don't, take steps to try to neutralize those.
Yeah, I'd like to throw another thing out there too, Bill, because I think this is where, we have some clients. We actually have 5 or 10 clients that on a really ugly day, for example, or ugly week, we anticipate the potential for a phone call because, because of this aspect of the psychology of investing.
Yep.
That, do I need to get out when there's trouble, or do I add. If we own quality things, for example.
Well, but the people who get fearful on days like yesterday and today, they're generally not calling to add.
Oh, 100%. And so, that's generally what we're doing. We're looking for opportunities on down days, and we're actually trimming things on up days. But this is the point that I wanted to make, is that the markets are a discounting mechanism.
Mm-hmm.
So there's this thing that called the efficient market hypothesis, and there are several different versions of it. But the efficient market hypothesis would say that, if I opened up the Wall Street Journal with all these stock names right here, that we wouldn't be able to do any better than a monkey throwing darts at it. Okay, that it's random, or that. So that the markets are efficient in that, and they are efficient in that they're discounting into the future 6 to 12 to 18 months. So, for example, if I hear from a client that, well, this is happening next week, so get me out now, or we know this is going to happen in 3 months, or the Fed just said that they're going to take the Fed funds rate to 5%, and it's only at 4.25%. And if interest rates go up, the stock market goes down. So get me out.
Or how about this? Timing a purchase or a sale of a stock around a dividend payment.
A dividend payment or an earnings release.
Yeah.
I have a few clients that try to trade earnings announcements. I mean, the probability of making money on a trade like that, it's a coin flip, because there's too many analysts that make $10 million a year on a blue chip stock. There might be 50 of them, and they're all disseminating this. So these stocks are efficient stocks.
Yep.
It would take new and different information to change where that thing is trading. So you have to keep in mind. But here's one of the things that I would say when you talk about methodology. I look at you can use common sense to look at like the price to earnings ratio or other accounting based metrics, or where does the market historically trade, and then you can compare it to the level of interest rates too. If interest rates go down, that warrants higher PEs, and vice versa.
Well, and those are useful heuristics.
Right.
They're shortcuts and they're helpful, but it can't stop there. Your analysis can't stop there.
Oh, that's exactly right. Well, here was the point I was going to make about that. So everyone is saying that the market looks very reasonably priced with a PE of 18. Well, if that's dependent upon earnings, and the earnings numbers, if we go into recession, the PE, the E part of the PE is going to be in decline, which is going to make the PE escalate.
Correct.
So those are things to consider.
Right. But
today,
in line with the efficiency of the markets, the consensus is recession next year. So it would be reasonable to deduce that analysts have already factored in lower earnings for next year.
I would counter that with this: is most of the things that I'm reading is that analyst expectations about forward earnings have not come down yet. So that could prove to be problematic.
Well, maybe the bottom up analysis will outdo the top down analysis next year. So perhaps focusing on the fundamentals, looking at a company as a standalone entity as opposed to taking a big macroeconomic view, may win out next year.
Well, I think as we've done this year, security selection is going to prove to be important.
I agree. But when you talk about market efficiency, it's not perfect, but it's pretty good. These prices, these security prices, reflect the collective views of market participants.
Right.
Now, Could the market be wrong? Yes, no question, the market could be wrong. But I think it would be safe to say that whatever the current market price is of a particular security, that's the base case. And then you have to know if you have some kind of edge. What is your edge? Do you know something that no one else knows? And see, this goes back into the biases. We overestimate our own abilities. We feel like, oh, well, we know something that all these other market participants know that they don't know. We know something they don't know. And so you have to be careful with that.
I mean, there are other biases too. I mean,
Oh, sure.
I think about this. Look at the lessons we've learned with the media this year. Okay. I mean, most of the media is terribly one-sided and ignores
Pushing an agenda.
the other side. Yeah. So we could be getting bad information that we base our assumptions upon.
So anyway, that was a lot of good information.
Yeah, I think so.
Yeah. So if you enjoy, reading the forecasts, have fun. I could recommend some other reading that would be more enjoyable, but have fun. It might be your thing. We don't dismiss all of that. We certainly take it into account, as we should, but we also weigh it. And anyone, you don't even have to be a professional. Anyone can get online and look at the consensus analyst ratings on Stock ABC, or you can get online and you can look at economist forecasts and so forth and so on. Just understand that most of those forecasts will be proven wrong.
I want one more point that slipped me, and it just came back to me, William. We're living in an age, in particular, the bond market. Okay, so this year, both the stock and bond markets have been held hostage by inflationary printouts,
Yes.
and the forthcoming inflationary printouts, and what the Federal Reserve is going to do about that. Okay, but here's something to consider with all these forecasts. We're living in an age where the world central banks have played a huge role, or you could say governments have tried to determine price action in some ways, yield levels. The bond markets in Japan, Europe, and the United States are especially manipulated bond markets. We've undergone all this quantitative easing since 2008, and we're now doing, I think it adds up to $95 billion a month in quantitative tightening. So you have to factor, some of these things
Sure.
into place as well. Government's role in all this, because it violates some of the rules and methodologies that we come up with. So anyway, I'm sorry. Thank you.
Yeah. So with that, we'll wrap it up and wish all of you a nice weekend. And even down here in the deep south, we're expecting very cold, frigid temperatures next week. So if you haven't already, winterize your house.
Okay, and hold on. Sports.
Oh,
Nothing.
Yes, the bowl season has begun today, kicking off in the Bahamas. But I know of one gentleman there who's been locked up, not attending the bowl game.
yes.
The crypto guru. So, yes, we started today with UAB in Miami. That game is over now. And we have Troy and University of Texas at San Antonio. These are some of the less desirable bowl games to watch. But we do have Louisville and Cincinnati tonight. This is an exciting time for me. We have the next week. We've got next week, this Friday, will be the Independence Bowl. The Radiance Technologies. Do you know who Radiance Technologies? What do they do, Bill?
Technology that radiates.
Technology.
That's
Yes.
the gates.
They are.
It's one. By the way, it's one of the older bowls.
Yeah, it's 40 something years old, I think. They've made improvements to the stadium. I think they usually do pretty good with attendance. They try to have regional or local opponents. This year's Independence Bowl game will be Houston versus, they say Louisiana. Louisiana is ULL in Lafayette. So if you're a graduate of Louisiana Monroe, you don't like it that that they say this is Houston versus Louisiana. But then the bowl season and schedule kind of rallies and builds through New Year's. And LSU is playing Purdue. Drew Brees has taken on a temporary coaching position with Purdue to try to help them defeat the Baton Rouge Tigers.
Turncoat.
Yeah, really. So, and on Tuesday, we have this really isn't news. The finals of the World Cup, Argentina versus France. I won't be watching that unless I'm a passerby on the TV set. But I'm much more excited. We got Saturday NFL games now because the college season is over.
I mean, look, to each their own. But, you know, if it were real football, they would raise their goal. It's on the ground.
That's a
How
good
hard
idea.
is that?
That's a real good idea. I say they have to get rid of the offsides rule. No American wants to see a game that ends 0-0 and has penalty kicks.
Exactly.
Okay.
All right, let's get out of here.
Let's end this.
Thanks for tuning in.